risk assets. Let's get more on what we're expecting today with Chris Weston over at IG in Melbourne. Chris, thanks so much for your time. We appreciate it. In terms of the developments overnight, and in fact just early this morning, we're seeing that, or hearing that President Obama and also House Speaker John Boehner will meet at the White House very shortly to once again discuss the fiscal cliff. We did get some more rhetoric on this overnight and it wasn't good. We heard Boehner saying that it's clear the president isn't serious about cutting spending, but spending is the problem. It seems like this gulf is widening, Chris.
Yeah, it does. It's quite painful, actually, to be honest, Kate. We saw John Boehner coming out and saying that he was on his way back to Iowa yesterday, or overnight, sorry. And now, like you say, it seems he's doing a bit of a U-turn, and he's coming back to the White House to discuss things again. I mean, what we've been seeing from President Obama is this 1.4 trillion in revenues, which he lowered from 1.6, but still, that's not enough. Mr. Boehner wants to see a more balanced approach, wants to see more on the spending cut side of things. Mr. Obama, President Obama, wants to continue pushing this tax rates, higher for the top 2% as well. It just seems no leeway at the moment, and it really is very, very painful, especially when you hear some of the sort of backbencher Republicans who have given their voice on different media channels as well, and they're just blaming the Democrats are blaming the Republicans. They just seem very, very far away. Of course, the market does seem to be giving them the benefit of the doubt at the moment. But yeah, I think given the fact that the S&P is up 7 days in a row, I think we're probably due for a little bit of consolidation. It wasn't an all-out panic attack. I also think the Fed policy side of things was still being disseminated and digested by the market. There's still a lot of people trying to work out exactly what these new economic thresholds of 6.5% employment rate will actually mean to portfolios longer term, and how they're going to position themselves around that. The Fed will be buying and expanding its balance sheet by another 45 billion, but most of that will be coming at a slightly lower duration from what Operation Twist was doing, so it leaves the back end of the curve slightly more exposed. There hasn't been any kind of inflation concerns. I mean, if you look at break-evens at the moment between 5-year and TIPS, which the bond market is their prediction of inflation, it's still running about 2.1%. So people aren't really concerned about inflation at the moment, but they are still trying to work out exactly what this means. I think there's a little bit of confusion there at the moment, but I think ultimately this will be considered a big positive move for markets, and especially for equities going forward. But yeah, I think what we saw last night was just this clear message by John Boehner that the Democrats are just not doing enough. They're not taking it seriously, which is a line they've been running with for a couple of weeks, and they're just not coming out with. Well, President Obama's just not coming out with a balanced enough approach, and that's why the S&P was down about 0.6% or so.
Yeah, Chris, in terms of the interest rates being linked to those economic indicators, which I know you actually picked on market day when we were up here just the night before, you got it. Everyone else thought that was going to come a little later down the path, but you got it. I just want to ask you, you mentioned there that the market hasn't digested the portfolio implications of that. I just want to ask you why you think the Fed decided to do this, why that change in strategy, taking it out of that 2015 and linking it to those two specific indicators.
Well, I can't exactly say why they've decided to do it now. The Charles Evans, who's the Chicago Fed president, ran with this idea many, many months ago, and that's why a lot of people have labelled this more, this larger focus on economic threshold of trying to link it to 6.5% employment and taking that their threshold for inflation from 2% up to 2.5%. Charles Evans ran with that a long, long time ago. That's why they're calling this the Evans rule now. There's actually been a number of other Fed members who have been coming on board with this idea over the last 5 or so months. So there's probably been about 4 members of the 11 who actually were going along with this, and it just seems that Bernanke has shifted his focus and said that this is probably the right way to go as well. What I will say is, while I don't actually know why they've decided to do this meeting, there's 2 things. First of all, there's a lot of people in the market suggesting this decision to ease policy even further has given the politicians probably more scope to get away with more for longer. It doesn't give them any kind of incentives to do well while the Fed are effectively backstopping the economy in the short term, and certainly helping out risk assets, which have had a nice run up into the Fed meeting. But I think the other thing is, it's probably given the fact that the 4 people who have been calling for this side of things were significant doves. You'd probably say this was a small win for the dovish camp of the Fed going forward. And what I think will happen now is every unemployment or payroll payrolls report, which happens obviously on a monthly basis, will get so much more significance now, because when we start seeing that unemployment rate trickle down, and if you look at the trend, it's been trickling down to 7.7%. When we start getting down to 7.1%, for example, markets will front run that. You could really quite feasibly see in 2013, probably towards the back end of the next year, dollar strength at the same time we're getting equity strength. Of course, we're so used to having a situation where dollar rallies and the equities come back, and the dollar's been used very much as a risk-on, risk-off proxy. You could actually see a situation where markets say, look, we've got the unemployment rate down to 7.1%. We're only 0.6 percentage points away from that threshold. And that's when you're going to start seeing the dollar moving higher, and you're also going to probably see equities, because a 6.5% is going to really be very good for growth, and then growth is going to obviously be very good for equities at times. So there's going to be some very interesting dynamics. But what's very clear is that payrolls number is going to become very, very significant going forward.
OK, let's move lanes and check in on Japan now. We've got the election this Sunday. We should get the result through sometimes Monday morning, our time now. A new poll out on the last few days showing that there's more downside risks, really. Now, just looking, so we've got the major party there, which is expected to get in, the LDP. They're supposed to be stimulus friendly, and the polls are suggesting that they'll win and that things should change over there. How do you think the market is preparing for this? We have seen weakness in the yen already.
We have done. I mean, the yen since I think mid-September's dollar yen's up nearly 9%, and up about 9%. Kiwi yen this year is up nearly 20%. It's been an absolute tear, and every currency's gained significantly against the yen. So the yen's now the market's funding currency of choice, more so than the dollar. So that's been the place to go. But I think that there are some downside risks. I'd agree with the Reuters poll. The market's priced in a landslide LDP victory. The latest poll was 242 seats out of the 480 seats that are possibly on offer. 320 seats, which is not expected, but if we did get a surprise, would be very, very positive. It means they could rewrite BOJ law, which means they could effectively put in a much more significant policy. Since 1972, there's been 13 lower house elections, 12 of which have resulted in good gains in equity markets going until that situation for both the Nikkei and the Topix. The week after has traditionally been a sell-off period, so like the Fed meeting, there is a real sense that we could get a buy the rumour, sell the facts scenario. And I think an LDP victory, landslide victory, is probably fully priced into both the Nikkei and the yen right now. So there could be a situation next week that we get profit taking. What is I think misunderstood is that an LDP victory doesn't mean that there's going to be easier monetary policy. That they can't do that. The Bank of Japan have to do that. What will it be the interesting thing? In March, there will be an upper house election, and if the LDP party pick up the victory, then they will have full control over the diet, which means putting through policies both on a fiscal level is going to be much, much easier. But then they can actually instigate who they want to be the head of the Bank of Japan, which happens in April. That's when they can get someone really radical in who will go along with their policy ideas. So I think the yen will continue to be the funding market's currency of choice. There is some downside risk next week because there's been a lot being priced in.
OK, Chris, let's take a look at one of the stocks set to move at the open, APN. We got a profit warning from them after the close yesterday. Do you think it's going to be smashed today?
Unfortunately, yes. I mean, there's a few people who bought into it yesterday, whether that was short coverers or not. This isn't really what you want to see. I mean, good news or bad news usually follows bad news and bad share prices, and the stock's down 55%. So, what they came out with their net profit between 51 and 54 million. The market's looking, or the consensus has been 61 million. Publishing down 10% in the second half. The market was looking for about a 5.5% decline. So clearly that it's showing again that their publishing division is facing all sorts of cyclical and structural headwinds. That you can look at their publishing EBITDA, what was it, 84 to 87 million. The market was looking for over 100. Their full year EBITDA is now going to be well below consensus as well. So just looking what the market's being priced in, you'd expect the stock to be coming under some significant stress as well on the open, even though it's down 55%. So I don't think this was fully priced into markets. So unfortunately for shareholders, this will come under pressure. They have come out and said that there's going to be new cost initiatives which will offset some of those losses, which is a positive. And the other thing is that they have come out and said that they will look to sell some of, they've got strategic buyers for those New Zealand assets. Again, that wasn't fully expected right now, and I think that could cushion the blow to a degree. But I think those earnings revisions will probably see the stock down relatively heavily. OK, Chris, thanks so much. We appreciate it. Thanks, Kate. Moving offshore, and Eurozone ministers have agreed to provide nearly 50 billion euros in long-delayed aid to Athens, prompting Prime Minister